So a lot of people spend time when day trading on the 5 minute and the 15-minute time frames. But day trading logically is about understanding where the next daily candle is most likely to print. You either have a bearish candle or a bullish candle. Now here, for example, we know that the market rebalances inefficiencies and delivers to liquidity. It's the function of the market. Now your narrative from the higher time frame is to understand, are we at a point of interest, or are we coming from a level from where we can expect price to continue its direction or reverse its direction? Now another layer on top of this is that the market runs on narrative and sentiment, right? Namely, macroeconomics, politics, geopolitics, current world affairs. Now, without truly understanding technicals and narrative or market sentiment, you can't really you can't really pinpoint or know that the market is about to reverse or continue its direction, right? Market trends are based on macro narrative. It's not based on 5 minute supply and demand levels. In the world you have real life supply and demand, which actually can make a market trend or make a market reverse. So from here, for instance, we had a sweep on previous weekly low, we had a weekly fair value gap here, and we had a sweep and a displacement higher. Now from this level, it's about understanding, are we really at a point, because from here you're assuming that price will trade higher here, because we've made a sweep of key levels and we've reversed higher. Now given that, so for Euro USD, right, negatively correlated to DXY, on the assumption that there is a ceasefire agreement between the US and Iran, you can expect that this key imprint on the market will drive the price higher. This is aligning technicals with macro narrative. Now hedge funds, for example, they trade 80% macro and 20% technical. Retail traders trade 80% technical and 20% macro. Now there's a very big reason why retail traders are losing. More than 90% of them, right? More than 90% of retail traders are losing money in trading. Why? I just literally spelled out for you. It's the fact that you're relying on 5 minute and 15 minute supply and demand zones, and whether you trade SMC or ICT, etc., it doesn't really matter. A technical that is lined up with a macro narrative is what matters in trading, right? Your technical only matters when you have a macro narrative. For example, all along here you have this bearish fair value gap and this bearish fair value gap. Now, when you're seeing a close like this in price or bearish fair value gap, now the daily candle has tapped into the level and rejected lower, closed lower. So you're going to expect that price is going to reverse lower from here. But the point of the matter is, what is the macro narrative? Because the macro narrative is going to trade through your key levels, right? And your macro narrative is going to carry on higher from your key levels, right? Here, sweep, higher. Here, sweep, higher. And the candle bodies here are respecting this bullish fair value gap. Now, the most important thing is this daily for a day trader is the weekly and the daily time frame. a sweep on previous weekly high and low, you can expect price to reverse from these levels here. Previous weekly and daily highs and lows, here price reverses, right? The narrative here, with the current geopolitical situation we have between US and Iran, it was bearish, right? So from this point, this sweep on liquidity here, you can expect price to just fall down it, right? Fall down towards a key level. Now, is it a coincidence, right, that after that sweep we come right into this weekly fair value gap, right? We swept liquidity and now we've rebalanced an efficiency, and now we're reversing higher again with the narrative that now there's a ceasefire agreement, which is very coincidental, right? Right, how these technicals are aligning so perfectly with with the current macro narrative. Now from here, you had the sweep and the weekly fair value gap here, and here you have this low, this high, this low, this high, high. These two up close candles, your daily, your breaker block on the 1 hour time frame. This is where you have an opportunity to enter into the market, right? And you can again sweep liquidity levels, right? Now, given the US and Iran issue, more important than foreign currency, right, is gold and the stock market, the US stock market. Now again, as what I just showed you on Euro USD, bearish fair value gap, rebalanced, price reverses lower, right, with the narrative of the US-Iran issue, and then another sweep on previous daily low and reversal higher, previous weekly low here, and now we're just reversing higher. And again, your technicals only matter once you have a macro narrative to back it, right? So for example, from this level, you have this 1 hour order block, and you can just expect it to essentially just carry price higher. Likewise, you had this bearish fair value gap, which again is, for as long as the macro narrative is bullish, this bearish PD array is going to be disrespected and traded through. Now, time frames are fractal, right? So whatever occurs on the daily is the same thing on the 4 hour, given that they all, we have the your X and Y axis, right? You have price and you have time. Likewise with crude oil. So on the daily, ultimately you had a sweep on this previous daily high. Likewise here, bring it down to the 4 hour. This will be the sweep on that previous daily high, and price just falls off lower. Now, how much do technicals truly matter? Right, we said hedge funds are, well, hedge funds are 80% technical and 20% macro. I mean, 80% macro and 20% technical. Retail 80% technical, 20% macro. How many technicals do you have here to line up with? Like, I trade ICT concepts. I can be 100% certain with you that nobody is using this order block over here to line up for a short. The fact of the matter is, when you have the macro narrative indicating a bearish trend in the market, you just position yourself wherever you can to get an eye with a short, right? So this order block here, how many people are really going to trust this order block from right up here to go short? When you have that macro narrative and the sentiment in the market that we're bearish, it doesn't matter where your PD rate is or how it looks. You can trust it every single time because the market is running on macro narrative. So you already have the expectation that we're going to go short. And the technical is there to essentially push price for price to retest that level and then push away from it in its intended direction. When you can understand exactly where the higher time frames are going to go, namely the weekly and the daily time frame, that's when you can understand how to align with time and price for day trading, right? On the 15-minute and the 5-minute, even the 1 hour, right? As a day trader, you want to reduce variance. Variance meaning the time frames. The lower you go, the more candles that are going to print, the more technicals you will see on the screen. The technicals that matter are the technicals from the higher time frames. You don't want to go anywhere below the 15-minute. The less variance you have, the less you have to consider, right? The 15-minute, the 1 hour, the 4 hour, these time frames are all very clear as to where price is going to go next, right? The 15-minute, you have one candle printing every 15 minutes. On the 1 minute, in that same time span of 15 minutes, you have 15 candles printing. So the less variance you have, the more clear and simplistic your trading will be. So once we have these the macro narrative, the daily, the weekly key high time frame key levels, once you have those aligning, that's where and when you have opportunity in the market. Before that, if the daily or the 4 hour time frame, they're not clear to you as to where price is going to deliver to next, you don't want to engage in that price action. You want to wait for when there's clear narrative in the market, when there's a clear trend. The less you do, right? Same thing with variance, right? The less that you do, the more fruitful that it is. Consistency in trading is found in being selective with your trades. Consistency isn't necessarily in frequency and execute 10 trades a day, so on and so forth. You can execute one trade every single quarter and be a successful trader. You can execute one trade a week, one trade a month and be a successful trader. As long as you align with opportunity and you have time and price aligning together, and you can consistently repeat that over and over again, you'll be a successful trader.